Good morning and welcome to KBRA's teleconference on the state of the solar market. I am Kate Kennedy, Head of Media Relations, and I'm joined this morning by my colleagues across our project finance and ABS groups who will be discussing KBRA's view on the solar market. Our prepared remarks will last approximately 30 minutes, and we will then address any audience questions. To submit a question, please use the webinar platform, or if you're using the dial-in number and not your computer to listen today, feel free to email any questions to info@kbra.com. I would now like to turn it over to Andrew Giudici, Managing Director and Head of our Project Finance Unit.
So shifting over from utility scale projects over to distributed generation, as I mentioned, we rated our first distributed generation deal in 2015, which was a Solar City deal. And early on, what we saw was most of the deals we rated were installations on residential properties, and they were backed by PPAs and leases. The first deal we done was relatively straightforward without tax equity, and then we started to see tax equity start to be included, which it progressed over time from inverted leases, which were relatively straightforward, to partnership flips, and which posed some complications, which we'll get into momentarily. We do expect, though, that the asset class will start to change over time. We think that loans are going to start to account for more of the financing in the distributed generation market as tax credits are phased out, and it becomes more difficult to raise tax equity or finance the installations with the PPA and lease model, given that there's just less tax credits in order to monetize and help finance the installation cost. Right now, developers, for the most part, are raising capital through the debt markets and the sale of tax equity to fund the installations. We do expect that to continue, but slowly start to decline as the investment tax credit is phased out over time. Some recent developments in the space that we saw is that in certain cases we're seeing financing done at the cash equity level. So from a tax equity structure, the cash equity element is being sold, and then there's a third party who's coming in and putting debt up at the cash equity level. Depending on how it's structured, it could be rated investment grade, but similar to the risks that we mentioned for utility scale back leverage projects, we would expect these type of deals to have a higher debt service coverage ratio to account for potential volatility in cash flows. We've seen similar collateral be financed both in the project finance and ABS markets. So if you just think about a portfolio of residential installations, that same portfolio could be financed in an ABS structure or a project finance structure. And really the difference is the transaction structure itself and the specific elements that are in these transactions that mitigate risk. So for the most part, what we would normally see is that a project finance transaction would have a lower advance rate and a lower rating when compared to an ABS deal that had the same collateral. And the reason is that on the project finance side, what you're seeing is it's usually structured as a loan, which allows equity distributions to occur. The transaction is somewhat weaker than an ABS. So on the ABS side, what you have is you have a full cash sweep. So all money that's coming in is going out to repay debt, and then the sponsor has less flexibility than they would on the project side. So given the more protections on the ABS, we usually see a higher advance rate and a higher rating. In terms of our assessment of these transactions, we've identified 5 major risk categories. And these risk assessments are similar from both, for the most part, they're similar from utility scale projects and distributed generation. So we look at production risk, technology, O&M, competitive position, and transaction structure. So as I mentioned previously, on the production side or the generation side, we use a 1-year P90 when forecasting the production for a utility scale project or for a distributed generation portfolio. So there we're looking to a resource consultant and we're looking at what their forecast is. We review that forecast. If we think that there's some shortcomings to it, it's possible that we could make adjustments in our analysis. But for the most part, we'll use the 1-year P90 that they've come up with. In terms of technology, while it's a major element in terms of our overall project risk factor, it's one of the risk elements that could lead us to limit a rating to non-investment grade. So if we're looking at a project or a portfolio of installations and we believe that the technology is not proven, or there's a great level of uncertainty with its performance over the long term, we could limit the rating to non-investment grade just because of the uncertainty on long-term performance. The next risk element that we look at is O&M. So there we're looking at who's providing the O&M services, what are they providing, and how are they being compensated. And this has actually become more important recently, where we've seen a shift from inverter replacements to having them refurbished. And in some cases, what we've seen is that it's the O&M provider's responsibility to refurbish the inverters, but in certain cases, the credit quality of the O&M provider is lower than the transaction we're rating. So in that case, what we need to do is we need to assume that the O&M provider needs to be replaced at some point during the financing. And what we want to make sure is that what they're currently charging is enough to attract another O&M provider to come in and take over the same responsibilities in a distressed scenario. So we'll work with the IE to determine what they think, and then what current market rates are for the services that are being provided. If it's lower than what is currently agreed to, we'll increase our O&M forecast to account for the potential replacement of that provider. The fourth item we're looking at is the competitive position. So that's really an assessment of the contract in place. So we'll be looking at the PPAs or the lease agreement. We're going to look at how they're being compensated. Are there any minimum production guarantees that need to be met, or are they performance guarantees? And we'll take all that into consideration when we're performing our model. The last one is the transaction structure. So there we're looking at the terms of the tax equity, the repayment waterfall, and the collateral. In terms of the collateral, what we're looking at is it an equity pledge, or do you have a lien on the assets, or is there a foreclosure forbearance? All of those specifics will could impact the rating and the overall advance rate on the rated transaction. Some major differences between distributed generation and utility scale projects, at least in terms of credit risks that we've identified. As it relates to distributed generation, we think the most significant risk in these transactions is the value proposition. So what we mean by that is that the contract that the customer enters into provides them with an economic savings. So we believe that electricity is an essential service, and that a homeowner or a commercial property or an industrial, they need to purchase electricity and they need to utilize it. The question just becomes, given that they're able to buy the electricity from their solar system or the grid, what's the most economic source? So what we do is we compare the contract of the solar PPA or lease against where we think utility rates are going. So we'll take where utility rates are today. So retail rates, we usually increase them by 1 or 2%, and then we compare the solar contract rate in each period. So in many cases, the PPA or lease includes annual escalators. We'll compare the contract in each period against the forecasted retail rate, and contracts that are out of the money, we assume a certain percentage of those are renegotiated. Whereas on the utility scale side, if a large IPP or utility enters into a contract, even though it may be out of the money, we assume that they continue to make those payments. The other is customer defaults. As I mentioned, on the utility scale side, we're looking to the credit quality of the off-taker. If that is higher than the rating on the project, we assume that they continue to make their payment. On the lease or PPA side, at least on the residential side, what we're seeing are FICO scores, our consumers who have entered into these contracts. So what we've done is we take those FICO scores and we run it through our mortgage model to come up with defaults. We then double the defaults that come out of the mortgage model to account for credit deterioration over time, given that many of the contracts allow them to be reassigned. If you just look at historical mortgage data, what you see is that a home is sold every 7 years. So for a 20-year PPA or lease, that home or the contract could change hands 2 or 3 times. And we use mortgage defaults in that case because, as I previously mentioned, we think that as long as the solar system is providing economic savings, that they're going to continue to purchase that electricity. But if the homeowner were to default on their mortgage, they're likely to default on their lease or PPA as well. And then the major difference on the utility scale side is construction risk. So we don't see any development or construction risk on the distributed generation side, but we do see that on utility scale projects. And we've rated projects that had construction risk that achieved investment grade ratings. And in certain cases, the EPC was actually not rated investment grade. So if we look at a case where the EPC or construction company is rated lower than the project, similar to what we did on the O&M side, we're going to have to perform a replacement analysis. So we'll look at the construction schedule. We'll assume at the worst possible time the EPC provider defaults and that we need somebody else to step in. We'll work with the IE to determine how much the contract price could go up and how long it will take somebody else to come in. So we'll assume that construction is delayed, cost increase, and then we'll apply these assumptions against the transaction structure and financial position to determine if it could withstand that liquidity stress. If it could, then it's possible that the project could be rated higher than the EPC. If it can't withstand that stress, then the project's rating becomes linked to the EPC during the construction phase. With that, I'm going to turn it over to Cecil Smart, who will provide you with an overview of tax equity and how we look at the specific risks.
Good morning. As Andrew kind of touched upon briefly, tax equity has become to greater prominence as a part of these transactions since the expiration of the cash grant program in 2011. Essentially, the motivation for having a tax equity developer enter into a tax equity structure is simply because they need the upfront capital and they don't have the tax liability that they'll be able to take advantage of the credits that are provided them through the governmental programs that are out there. So what has happened is that developers have partnered with institutional investors, i.e. tax equity investors, to transfer the tax credits afforded the developer under installation of these solar programs. So those benefits are in the form of accelerated maker's depreciation, which essentially means that the assets are depreciated over 5 years instead of their useful life, which generally could be up to 30 years. There's bonus depreciation, which gets another 50% of the basis in the systems themselves. The bonus depreciation program expires at the end of this year. And then there's a third portion of this called the investment tax credits, which is equal to 30% of the fair market value of the systems that are installed. And those three benefits are all additive. So to the extent that the developer finds a tax equity investor, the tax equity investor achieves most of its benefits within the first year or two after entering the agreement. With respect to the investment tax credits, as I mentioned before, is 30% of the fair market value. And that fair market value is determined by an appraiser, which can be either the replacement costs of the systems themselves, the discounted cash flow, or the actual market value of the systems. The three primary tax equity structures that are in vogue, the sale and leaseback, the inverted lease, or the partnership flip. The two structures that KBRA has rated, and with respect to the transactions that Andrew touched upon earlier, involve an inverted lease and partnership flip. We haven't seen a sale and leaseback. So to give you just a thumbnail sketch of how inverted leases look, the tax equity investor and the developer would contribute capital down to a master tenant. The master tenant would then partner with the developer to contribute capital to a lessor. So the lessor and the master tenant are newly created entities. The developer's capital with respect to the lessor are the systems themselves that are being installed. the master tenant then subleases the systems to the customers, the end users. The master tenant then receives rent from those customers, and then some proportion, the lessor's portion, the master tenant's portion of the cash that comes in the form of rent gets forwarded to the lessor. With respect to the partnership flip, tax equity investor partners with a developer who they create a partnership where all of the systems are contributed down to that partnership. And the ownership structure is put in place such that 99% of the tax benefits reside with the tax equity investor and 1% resides with the developer. And it remains in that, with that allocation from an accounting standpoint, it remains with that split until a flip date. And that flip date can be either a fixed date and time, or it could be yield-based. And if it's yield-based, that's written into the agreement between the tax equity investor and a developer. That is based on the actual cash flows coming in from the systems themselves. As I mentioned before, the ownership structure of 99%, 1% is an accounting split. The cash is split differently, and the agreement with respect to how that cash is, the cash is split is actually written into the agreement also. After the flip date, that 99-1 split flips, where that 99% of the tax benefits and accounting benefits now reside with the developer, and 1% will go to the tax equity investor. Now, with respect to the risks posed of these tax equity structures as it pertains to the rated transactions, the primary risk is that all of the cash, all of the obligations under the tax equity agreement sit senior to any cash that will be made available to service the debt. So it is truly back leverage. In addition, to the extent that if there's significant underperformance of the systems, there might be additional cash sweeps that are put in place in order to make sure that the tax equity investor achieves its contractual return as written into the agreement. In addition, the IRS could challenge the fair market value that was used to determine the level of the ITCs, the investment tax credits that were used to reduce its overall tax liability. So the IRS has 5 years from the date of the last installation of the systems that were installed in the partnership to challenge the fair market value basis. To the extent the IRS challenges the basis, that clock on the 5 years stops, so that everything tolls at that point. If the IRS challenges and is successful with its challenge, they will claw back the investment tax credits. And all of the tax equity agreements that we've seen, and I'm pretty sure this is probably universal, the developer indemnifies the tax equity investor for any clawback, any recapture of those investment tax credits. And that's something else that we take a look at when we analyze the transactions. Sometimes they might result in a flip date extension, or sometimes, depending on the tax equity structure, the money is just there's additional sweep to make the tax equity investor whole in relation to the amount that's been recaptured by the IRS. Now, as a result of that particular feature in these transactions, some insurance companies have developed products that will backstop that potential recapture. So what we look at is the type of coverage. Our insurance group here will perform credit estimates on the underlying insurance policy providers to make sure they are at or above the ratings of interest for the underlying transaction. In terms of how these policies are sized, what we've focused on is the unit cost associated with the installation of the systems themselves, and take a look at the soft costs. So our thesis is that the IRS generally would not challenge these direct costs such as labor and equipment, but with respect to overhead and profit, that's something that might be more challengeable. So what we do is we take a haircut to those soft costs depending on the rating category of interest. That could be anywhere from 40 to 50%, which will result in a commensurate reduction of the FMV of 20 to 30%. And then as a result of that FMV reduction, look to see if the insurance policy is covering that overall reduction, and if it does not, or if there's not a policy in place, what does that do to the overall liquidity strain of the transaction itself. As with respect to the ITC only is applicable to the extent, from the transactions we look at, to the extent that the ITC will remain with the developer / tax equity investors, but there are some solar sponsors out there that will pass the tax benefit to the customer, and these are coming in the form of solar loans, and Eric Neglia will now address that particular product that's becoming more prominent in the space.
Thanks, Cecil. As Andrew mentioned at the beginning of the call, KBRA has rated 2 consumer solar loan transactions, 1 public and 1 private transaction, and we expect several more solar loan securitizations in 2017 as the popularity of the loan product grows. KBRA is seeing growth in the residential solar loan market as more consumers are choosing loans to finance the purchase of the rooftop solar systems. Solar loan finance companies, they originate the loans through partnerships with pre-screened, often independent solar system installers or dealers, and the loans are used by the customers to finance the cost of the equipment and the installation, and ultimately displace the customer's current utility bill. Currently, we're seeing loans are offered to high credit quality obligors. They typically have credit scores around 730 to 750. Loans typically have original balances of 10 to 50,000, original terms of 10 to 20 years, and interest rates anywhere between 4 and 10% generally. Monthly payments are comparable to monthly utility payments, so they could be in the range of $150 to $250 per month, depending on the system size and the financing terms. Borrowers have the ability to select the financing option that meets their need. So they may choose a longer-term loan if they have a preference for monthly savings, or they choose shorter-term loans if they prefer overall lifetime savings. We're seeing customers choosing loans over other forms of solar financing due to a variety of reasons, one being the simplicity in financing terms and the financing process, the other being loan payments that are comparable to their current utility payment, and then the third one being an ability to realize the tax savings and lower their overall ownership costs. On the first point, the loans are fixed rate, fully amortizing loans that are applied for generally through the installer at the point of sale. Originators try to simplify this process to make it more appealing to consumers. Also, given the low interest rates, the longer loan terms, lower equipment costs and installation costs, the loan product is becoming more economical. And then the last point, under current law, individuals or businesses that purchase certain qualifying energy technologies, they may be eligible to receive the investment tax credit of 30% of the system costs. Up until this point, solar installations have generally been geographically concentrated, with the top 5 markets accounting for approximately 70% of national installations. Some of the larger markets have shown a slower growth rate over the most recent couple years. This is primarily due to some of the challenges and costs to reaching the new customers outside of the early adopters, and then also the extension of the ITC took some pressure off the installers and customers to purchase before the expiration of the tax credit. The slower growth and rationalization of the market is a positive development from our standpoint. Switching over to the securitization side, solar loan transactions have your typical ABS credit enhancement in the form of OC, subordination, and a reserve account. When there's loans in the securitization that have low APRs, there's generally a YSOC amount, which is included to adjust the collateral balance for certain receivables which have APRs below the blended note rate. Solar loan financing, it's a new asset class, so the financing companies have limited operating history for their underwriting criteria, and the loans haven't been through a full life cycle yet, and this includes credit stresses, technological changes, rising interest rates, or rising utility prices. So given the newness of the asset class, KBRA has to rely on proxy consumer data and then is therefore conservative in its loss assumptions and multiples until the actual performance is available, and originators have demonstrated a consistent ability to underwrite these loans. So at this point, that concludes our prepared remarks for the conference call, and I'll turn it over to Kate Kennedy, who's been reviewing the questions submitted so far.
Thank you, Eric. Just a reminder, if you do have any questions, please submit them to info@kbra.com or via the webinar platform. One question that we did receive from the audience, I'll turn it over to Cecil or Andrew. The question is, how does KBRA assess the benefits of extended warranties on equipment, i.e. inverter replacement?
Sure. So thanks for the question. So when looking at warranties, the first thing we look for is the credit quality of the warranty provider. If we think that their credit quality is below the rating of the project, we do not give credit to that particular warranty. If it's within the rating of the project or transaction or higher, we will give credit. But then what we need to understand is really what is the warranty covering. Is it a financial warranty? Do they provide replacement parts? Do they provide replacement panels or inverters? And then we'll take that into consideration when performing our analysis. So if it's a warranty from an investment grade inverter provider, we could potentially take that into consideration when we're performing our inverter replacement or refurbishment analysis.
Great. Let's see. The second question is, how has tax equity evolved over time? Cecil, you want to take that one?
Yeah, so as I mentioned before, the tax equity, what we're seeing more so is the partnership flip structure. And that allows, that creates more of an enticement for the tax equity investors to get involved in these transactions, and because more of the tax benefits are achieved sooner, it does, and it's actually beneficial for the developer, because since there are more tax benefits that are being passed along to the tax equity investor, that reduces the capital requirement on the developer side. So it's a win-win for both of them, both of the entities involved relative to what you see in inverted lease.
All right. Next question that just came in is, could you please elaborate on the transaction size and tranches on the recent solar CLO securitization? Andrew?
Yeah, so we haven't rated any specific solar CLO transactions. As it relates to kind of solar financing, I think the size is usually around 1 to 200 million. It depends on the structure that you're looking at. For the most part, we've seen, if it's a project financing, we've just seen either a note or a loan issued. So there was only one security there. On the ABS side, what we've seen is that there'll be either one or two tranches for the most part. Cecil, if you want to elaborate on the ABS.
Oh, actually, Eric's going to handle the loan side.
So I guess the question here that just came in related to similar to what Andrew just answered about, O&M risk, but looking more toward the loan side. So as most people are aware, the O&M refers to the operation and maintenance of the PV system. So KBRA does separate the O&M risk from the performance guarantee risks, which are often bundled or thought of together. The O&M risk addresses the responsibility to ensure that the system is operating and produces the power that's expected. In solar lease transactions, as we mentioned earlier, the leasing company typically owns the O&M risk, while in solar loans, that O&M risk shifts to the borrower. So the homeowner is responsible for servicing the system, replacing any damaged or worn out parts, and cleaning or clearing any panels to produce the expected power. Once installed and connected, these rooftop solar systems, they generally require minimal ongoing maintenance. Most service issues that we've heard of from the originators come through installation problems or defective equipment, which are covered by workmanship warranties, and they typically arise within the first few months. We do review certain aspects. Areas that we review are how the originator approves the equipment, how they approve the manufacturers, and the review of the warranty on the panels and the inverters. And then we also review how the originator monitors the quality of work that's performed by the installer, and how those installers honor their workmanship warranty. Since the failure to maintain and service solar systems, they could lead to a system breakdown, which could lead to delinquencies and ultimately to losses. What KBRA does is we add losses onto our base case, typically at year 10 and year 20 due to some equipment breakdown and failure to honor the maintenance.
Great. All right. Another one that just came in is in Resi Solar, because it is new to new ADS asset class. Is there an implicit rating ceiling on these deals? Single A, double A, et cetera?
So at Kroll, we don't have explicit rating caps on any product. Having said that, for the most part, what we see in relatively new asset classes is that the ratings usually don't get higher than single A just because of the uncertainty around the asset class. We then start to apply more significant stresses. So while we don't have an explicit cap, the stresses do get much more severe as you start to get out of that category. And I think what we've seen historically is, for the most part, new asset classes usually fall within the A category. Having said that, we've also rated some PACE transactions. Well, we rated 19 PACE transactions, and these transactions, for the most part, have gotten ratings in the AA category. And the reason we were able to rate PACE transactions higher than kind of single A, where you would see most new asset classes, is that we look at PACE similar to tax equity financing, given kind of the lien on the asset or the assessment, which is really being securitized. And we could look at tax lien data as a proxy there. So given the data we had, we were able to rate it higher than kind of what you would see other new asset classes rated.
Great. Another one that just came in: are loans or leases PPAs viewed more favorably by Kroll?
No, we have no preference over the product. We don't. It all depends on, I guess Eric kind of touched upon, the O&M that's attached to the underlying product. If the company's vertically integrated, how's that O&M going to manifest with respect to to the underlying customers? If they're channel partners, the strength of the channel partners, are these well-known channel partners or not? Again, we don't have any difference with any favored with respect to loans, PPAs, and leases. For the most part, the only difference is who retains the ITC at the end of the day.
Okay. Another one: what are your expectations for solar deals in the remainder of 2017, 2018, and beyond?
So we expect the issuance to continue to be relatively strong. I think 2017 so far has been one of the strongest years for solar financing, whether that's solar loans, it's PPA or leases, or it's actually project finance deals that have kind of been done in the private market. So we do expect the volume to continue to be relatively strong. I think, as we mentioned, over time, we think there'll be a shift away from PPA and leases, which will still account for a relatively significant part of the overall market. But we do expect loans to start to account for a larger percentage of the total financing. So we expect it to continue to be strong this year. We think it will be the strongest year. But over time, we think the shift will change. And then, obviously, depending upon specific regulations or changes in regulations, that's the real wild card. But if the status quo remains and the ITC declines or is phased out over time, and there's no significant changes in tax law, we do think that issuance will be relatively robust.
Okay, great, thanks. One more. How do you weigh the benefit of greater monthly savings on longer-term residential loans versus lower monthly savings on shorter-term loans? Monthly valuation proposition is better on longer term, but perhaps borrower equality is higher on those that are self-selecting shorter-term loans and focusing on overall IRR versus monthly savings.
Yes, I can address some of the points on that one.
Yeah.
When we're looking at the consumer loan side, we try to break the data out into variables that are going to be predictive of the loan performance. And to this point, what we've looked at is proxy performance data broken out by loan term as well as credit score. And we come up with loss assumptions for each of those. So obviously, the higher credit score, you'll have a lower loss assumption. And then as you go out in loan term, typically a lower credit quality borrower will choose that longer loan term just to lower their monthly payment. And again, that's typical, not always the case. And then also as we extend the loan term, you're going to have more instances of credit deterioration or more instances that may put the borrower into economic stress. So the loss assumption will go up on longer term loans as well. So we forecast loss assumptions, like I said before, by loan term, by credit score, and then extrapolate the loss assumptions for that term when data doesn't exist.
Okay, great. Sorry, we're getting quite a few in here. Another one. Can you discuss the loss rates experienced on existing ABS DG deals relative to expectations?
Right now, everything is tracking actually inside of our base cases. And these are, you can find these on our annual surveillance reports that are in our website. So to the extent anyone has any questions on those, we want to talk about those further, we can. But right now, we haven't seen anything that would give us any concern. In fact, the first MyPower deal we rated 2016-A, which was Solar City's loan program, was upgraded not too long ago.
Okay, and another, let's see here. How do you evaluate the optionality that some residential loans include regarding a prepayment on the loan at month 18 to coincide with the borrower's receipt of the tax credit?
Well, what we do is we look at the historical acceptance of the application, of application of the ITC refund by the customer to the principal balance, and then we make a haircut to that depending on the rating category. Now, that's what we do in the transactions currently, as Eric kind of touched upon this before, but to the extent that, and actually Andrew also, that we will see less people being able to take advantage of this right now, of the ITC over time, because not everyone's going to have the tax liability to take advantage of this. So the value proposition, as we analyze it, is going to take on greater importance because some of these loan programs where there is a step up, the customer may not be able to enjoy the benefits of that little savings to the extent they aren't able in a position to take advantage of the ITC payment. So that's something we factor in our analysis, and we just essentially haircut the historical data we receive for the underlying sponsors to see if the transaction can withstand the incremental defaults as a result of people not prepaying the loans as expected by the company.
Okay, thanks, Cecil. One more. Can you speak to how you estimate power rates for the different customers?
Sure. So when we're forecasting where we think retail rates are going, we do it at an MSA level or at a particular local utility level, and we get that information from EEI, and then we'll take current rates today. We increase them by 1% over the term of the financing. We realize that there's volatility in electricity prices where it could go up or down, but we think that a 1% long-term growth rate in electricity prices or retail rates is relatively conservative. So then once we come up with that forecast, what we do is we then compare the actual contract amount, which we get by looking at the terms of that financing, so the current contract rate, and we increase it by the agreed upon escalator.
Okay, another one that just came in. Does Kroll have a view on the impacts to tax equity if there is a major tax reform in Congress, especially with regards to a lower corporate tax rate?
Generally speaking, if there are changes to the corporate tax rate, as I mentioned before, the tax equity investor has enjoyed virtually all of the tax benefits for entering into the tax equity structure within year 1 or 2. And most of the, if not all of the tax equity structures that we have looked at, the tax equity investor takes the risk with respect to any changes to tax law. So it's something that wouldn't impact the transaction if we rated. Now, in terms of what the structures look like on a go-forward basis due to the potential changes, we may start seeing language where the tax equity investor doesn't want to take that risk, and some of that gets pushed back onto the developer. As of now, the tax equity investor is taking that risk.
Okay. How does KBRA view the risk of loans that re-amortize subject to IDC related prepayments?
Sure. So I think the specific example which we could relate to would be the Solar City My Power deal, which we, as Cecil mentioned, we recently upgraded. And what we did there is, in certain cases, the loan reamortized if the ITC payment was received. And then basically what would happen there is that the long-term rate would be lowered, so there would be a greater amount of cost savings. In our analysis at the time, we basically assumed that there would be zero prepayments under our rating stress. So the money that would come in when the customer received the ITC, we didn't assume it would actually be used to repay debt. And what we've actually seen is that a very large portion of the customers actually did that. And what that resulted in was a decrease in the contracted rate, an overall improvement of the credit profile, and an upgrade of the bonds.
All right. What performance data is available of actual system performance versus expected performance as projected by the IE, both on an annual basis and a seasonal basis?
So what we get from the IEs, and they look at the portfolio that we're considering in the transaction, and they provide not only production data by state, and sometimes with respect to California, we've seen that state broken into 10 subregions. And then we get seasonality performance also for each individual state or subregion to the extent it applies. And then we model each individual system. We don't do this on a portfolio basis. So everything Andrew's been talking about with respect to the value proposition, payment defaults, production, and seasonality gets modeled on an individual basis, because a system located in Arizona is definitely going to perform differently from a system that's located in New Jersey. So those things are all factored in to underlying performance.
All right, another one. Sorry, quite a few coming in. Last one here. Let's see. How does KBRA think about recovery and default of a resi PPA, a solar system that would be hard to repossess?
Sure. So in a default scenario, we assume zero recovery. So I think the point is that when you have an installation on a residential home, it's going to be difficult to take it off and then sell that to somebody else in the secondary market, given that in many cases the solar system is customized for a particular home, or that technology has been rapidly improving, that it would be a hard value proposition for somebody to take a older system if you were to try to put it on another home, whereas given the newer technology, better efficiency, lower pricing, we just don't think there's really any value in repossessing a system and trying to sell it.
And the other thing, from a tax equity standpoint, the tax equity partnership has to own the system for 5 years. So if someone defaults within a 5-year hold period, you can't sell the system and still enjoy the ITC that's been granted under the program. So that's another reason why we don't assume any recovery.
Well, that wraps up all of the time we have for today's call. If you have any additional questions that were not addressed on the call, please feel free to email us at info@kbra.com. Additionally, please visit our website, kbra.com, to view our rating and research reports related to the solar market. All of our thorough research is free of charge. Thank you again and have a great day.